Well, good morning, John. It's good to see you again. We are recording this on Thursday morning. Before we switch to the most, exciting topic, which is the US presidential election and what the impact might be on markets, I'd like to focus on Australia briefly. John, yesterday we got the CPI numbers. September quarter, 2.8% was the headline number. Well, that's within the range of 2 to 3%. Unfortunately, the underlying number is still a bit higher, I think 3.5%. And where we're not seeing much inflation on the goods side, we are still seeing quite high levels of inflation on the services side. How did you interpret the results? What does it mean for the outlook for interest rates in the country? And obviously that'll flow through to many aspects of economic activity. What are your thoughts, John?
Well, we saw an immediate decline in the Aussie dollar, which was extraordinary, about one cent, which didn't make any sense. And I expect the Australian dollar will battle its way back, but it's not going to go much higher because of capital flows. But when you look at the inflation numbers, the discussion about trim mean, which is nauseating, and I think it must be nauseating for the Australian public to hear this nonsense that they take out the biggest movers on the upside and the biggest movers on the downside and clip it and trim it to come up with a number 3.5%. Some of the outliers were childcare. Costs were double-digit, insurance is double-digit. Now, it goes without saying that interest rate increases are going to have nothing to do with those costs. Insurance is a world issue, and childcare is an Australian issue, very much around the cost of labour, which is playing catch-up after a surge in inflation after COVID. And whilst I'm not supportive of a lot of government policies, their policies to try and drive down the cost of living are absolutely right. It does question why we need an independent central bank who seems to ignore the importance of fiscal policy to drive down the cost of living, which will roll into lower wage increases in the future and bring down inflation. The alternative is that we create unemployment to drive down labour costs, and that's not where Australia wants to go or needs to go. And it's not where the rest of the world is going when we compare ourselves to our peers. So I sit back and look at that inflation number. It was predictable. I've been predicting inflation is going to come down dramatically this year. It is. The central bank doesn't want to cut interest rates because its interest rates arguably are still low compared to our world peers, ex-Europe. European interest rates are clearly 1% below Australia. Their inflation is only slightly better now, so they are on full throttle to try and get interest rates down. Australia will cut interest rates early next year. That's whether it happens before the election will be interesting for the government and the opposition to fight about. But our interest rates are holding up to try and hold the Aussie dollar stable, because that downdraft, Paul, yesterday was particularly bad news for inflation, imported inflation. And the Reserve Bank is in a real quandary. And rather than baiting the government with their nonsensical arguments, they should be supporting the government to get the cost of living down, to show the world that our real interest rates are going up, and that this is which would stabilise the dollar and have another benefit to our inflation rate. So a bit of a convoluted answer, but that's what I'm seeing. So much nonsense in the debate regarding inflation that I just sit back and just wonder when's it all going to stop.
And yet, John, the economy still seems to be quite sluggish. We also had a trading update from Woolworths. Now, we all know that Woolworths and Coles are facing charges from the ACCC for manipulating discount prices and so on. But let's put that aside. Consumers are obviously under pressure and are looking very closely at what they're spending money on, and so the trading update from Woolworths was quite a surprise. Stock gap down 6% straight away. Is this indicative of the overall economy, or kind of a one-off?
I think it's both. I think Woolworths are certainly concerned about the ACCC, and I think their announcement probably was aggressively stated. I'm not saying it's untrue, but I think it's aggressively stated. And in the stock market today, statements like that are going to cause market corrections pretty quickly because of the hedge funds. So again, I expect that stock to recover, and it was probably a buying opportunity. But there's no doubt that there's two forces playing in the Australian economy. There's the population growth, so there's more people eating who surely are going to Woolworths to buy their food. So let's give it a break. But against that, we've had wage increases, which have been chasing inflation, the cost of living, and that's going to take another year to stabilise. And the facts here, Paul, Australia's real wages declined 6% against inflation, the cost of living, since COVID. So that's going to have an effect on consumption patterns, and particularly the low and middle income earners are going to feel it more than anyone. And if you're a low income earner who's now paying 10% more for your childcare and 10% more for your insurance, and they're costs you can't avoid, it's like, of course you're going to adjust your consumption patterns. So these are all the issues where the government's got to stabilise the cost of living where it can, and the Reserve Bank's got to pull its bloody head in and stop fighting what the government needs to do. And I'm not saying Labor or Liberal. The government and the Parliament of Australia has to address the cost of living issues for low and middle income earners. And I keep on coming back to the obvious point that the tax cuts should have been more aggressive for low income earners, and there should have been agreement that those tax cuts would lead to lower wage claims by the employment sector. But because no one talks and no one negotiates, it's a wonder, the Australian economy. And our inflation reflects that. We have own goals everywhere in the Australian inflation cycle, which is affecting consumption patterns. This indexing of toll roads, what nonsense. The indexing of petrol taxes, what nonsense. Who comes up with that stupidity when you're trying to fight inflation and they're creating it in front of your face?
Overnight, we also got some new data from the US. GDP growth over the September quarter was 2.8%. So whereas Australia seems relatively sluggish, the US economy is, they've achieved their soft landing, or hardly a landing at all, down from 3% in the June quarter, but 2.8% for the world's biggest economy is quite an achievement. And this is in the run-up to the election on the 5th of November. It's all very exciting.
But what's your definition of a soft landing? I'd liken this to a moon landing where they're expending so much fuel to land the craft stably. And this is leading into something I want to alert our clients to and readers to, that I am publishing a letter in the next week or so, which will delve into the American economy, because it's now at the point where the American economy represents about 30% of world GDP, but consumes 30% of world debt. And the 2.5% or 2.8% growth we're seeing is against the 5.5% fiscal deficit. So it is a massive call on the world's capital to stabilise the American economy, to help it grow and to help it land softly, so to speak. But we should be aware of this, because this is becoming a growing problem for the world. The world is spending a lot of capital supporting the American economy. I would suggest the Australian superannuation system is spending a lot of our savings supporting the American economy. The American stock market is about 75% of the world stock market now. And these are becoming big issues, big risk issues for the world in terms of the over-focus and the magnification of the American economy. And yes, it's great that the American economy grew 2.8%. That's fantastic. It's great that it's slowing. It's great that unemployment's not rising. But they are doing that with a massive fiscal stimulation. And both parties, when I look at I know we're going to talk about the American election, neither candidate is arguing that the deficit should be substantially brought down. And that leads you to the observation, well, how are they going to fund this debt? And what if the rest of the world, it's not going to happen, so let's not get excited, but what if the rest of the world's capital market said, we're not going to fund the American economy anymore?
Yeah.
Well, the reason they are, because there's no alternative. Does anyone want to invest in Europe? Does anyone really want to invest in Japan? we all want to invest in China and India, but we're not confident about the stability of those economies and their legal frameworks. So it's a default investment in America, and America is lapping it up.
Yeah. The bottom line seems to be that you're kind of alluding to the discipline that the bond markets might end up applying to economic management, the so-called Liz Truss moment, where perhaps Trump's talking about spending something like $7 trillion. Harris talking about spending about half of that. And as confidence in Trump appears to be growing that he'll win the presidency, we've seen the Treasury yield creeping up. It's now 4.3. In Australia, it's 4.5, just by way of comparison. But 2 months ago, US Treasuries were sitting at 3.6. So is that the risk, a Liz Truss moment where the bond market imposes its discipline?
Well, I reflect on 2018 where we had a bond tantrum, and when people read my letter, it'll be recalled to them. And what happened? That the Federal Reserve turned around very quickly and stabilised the bond market with QE3. So, history tells you that the bond markets will send a warning sign to governments, and the central banks will come in and support the governments, as they always do. So that brings the hedge funds into play, who say, well, there's a trade here, we can short the bonds and then quickly jump on it again when the central banks come in and support the system. And that's where we're getting to. We're getting to a quite destabilised financial system, which is held together by largesse of central banks. And that's the reality of the situation. As I said earlier, the debt load of the world, the debt load of America is $30-odd trillion. Its debt, in terms of world debt, is greater than its world economy, than the US economy is a percentage of the world. These are big and developing issues, and they're in front of everyone's eyes, and it's as if no one wants to look at it. The interest bill in America is $800 billion a year, and that suggests that they're only paying about 2.1% for their interest. Now, if they start paying 4.5, on a long-term bond, and that flows through their whole funding, and remember, cash rates and short-term bonds are yielding 5%. So it won't be long before that cost of debt in America goes up by 1% across the yield curve. America's going to be paying $1 trillion of interest, right?
Yeah.
And mainly to the central bank, which is interesting, on printed money, and to a lot of foreigners, which include Japan pension funds, European pension funds, and Australian pension funds, And we've got to watch ourselves. Is that really where we want to go, that we just keep on pushing capital into the American economy for a very, it's been great returns. And this is the interesting thing. It's been great returns in the last 2 years after a very serious correction, as we know, in 2022. But looking forward, it's hard to see those returns continuing. But the most likely return is going to come from a continuing strong American dollar, which sucks in the world's capital. And this is what I'm talking about in my letter, and I just encourage people to read it. And when I talk to our clients in November, I'll be going through this in great detail and what it means for investment markets going forward.
So, John, you're about to commence a circuit of the capital cities to do presentations?
Yeah.
Can you tell us a little bit about what the plans are?
Yeah, well, a lot of client presentations, but we are doing public presentations in Perth and Adelaide, and I encourage Clime followers and Clime capital shareholders and anyone who's aware of our presentations come along. I do have something to say this time in terms of about the American economy, and obviously when I present it'll be after the American election. So we'll go from speculation to reality, which will be more important, and really delve into the inflation cycle which we're in. But my analysis suggests that income is going to become a very, very important factor in terms of returns in 2025. And there's some parts of the asset market which reasonable yield is available. And I don't see a world recession. I just see lower growth in the Western world, slightly accelerating growth in Australia, which supports income assets. And I think that's a thematic which I'd like to go through in those presentations.
So presumably we'll be able to attach the details about the presentations
underneath here.
to this.
So
This
please,
course.
so
Yeah.
please, if you tap on the invitation, and particularly in Perth and Adelaide, and grab a seat before they go. But I will say they're going to be quite enlightening presentations. But then again, I'm giving them, so of course I say. Yeah.
Well, we haven't really had time to delve into the presidential election and the differences between the Harris and Trump in any great detail, but I think there'll be other opportunities to cover off on that.
Well, Paul, next week we'll be able to talk about what actually happened.
Yeah,
it'll be a lot more interesting than speculating. And the final week, the headlines seem to be more about who said what and who offended who, rather than about economic policy. And that's America today. And I just say, look, enough speculation. Let's see what happens, and then we can make some rational calls about where markets and economies are going in 2025. I do maintain, I don't think there's little difference. I said, obviously, Trump's tax cut proposals are good for the corporate sector, but how's it going to be funded? He says it's going to be funded from tariffs, but tariffs put up inflation. So, it's an interesting argument. But let's just sit back and watch.
Fair enough. All right, John, I think we'll end it there. Thank you so much. And we'll look forward to those presentations and also to the letter to investors, which is a more detailed and sober examination, and which you'll be sending out, I think, next week.
I will.
Great. Thanks, John. Thank you very much.